Good day, everyone. My name is Yerlan Aubakirov, and I lead the compliance carbon markets team at S&P Global. It is my pleasure to talk today about carbon markets, and in particular, our new climate scenarios and carbon outlook globally. Earlier this year, we released 3 brand new scenarios. Those covered long-term energy demand, climate, and carbon pricing levels. In particular, our new adaptation scenario assumes that countries will continue balancing fossil fuel-powered economic growth. But this will be against heightened global warming. In fracture scenario, we see accelerated technological progress, but it's happening in a weak policy and government environment. In the Renaissance scenario, emerging markets will play a key role in driving late but accelerated energy transition. Our updated base case sees the world attempting to manage the instability and uncertainty of the 2020s and facilitate an energy transition away from fossil fuels. And the world still tries to meet the growing energy demand of developed and emerging economies alike. In this effort, the world is not entirely unsuccessful. The energy system of 2060 is far less reliant on fossil fuels than now, and emissions have seen decades of sustained decline. But energy transition is far from complete. These outlooks represent a very broad range of outcomes, but none reaches 1.5 degrees, except for our net zero case. And our net zero case is a speculative path to global net zero emissions by 2050. In our base case, global temperatures changes by 2.5 degrees, and fossil fuels still supply roughly half of energy demand. The adaptation scenario pushes temperatures even higher, and fossil fuels account for roughly 2/3 of energy demand there. On the other way of the spectrum, the Renaissance scenario delivers a more accelerated energy transition, but fossil fuels fall to roughly 1/3 of energy demand. Last, but definitely not least, is our fracture scenario. There, temperatures will rise by 2.5 degrees, and fossil fuel will account a little bit more than half of energy demand. Now let's turn to carbon markets. We'll start with EU ETS, the largest carbon market globally. Throughout 2025, we introduced new frameworks for our UA price forecast. So we updated our base case, and our base case now reflects industry competitiveness concerns. Right now, there is a limited appetite for very high ETS prices in Europe. That means ETS alone will not drive deep decarbonization. Other incentives will need to complement the ETS. So currently, most European subsidy schemes cover 20 to 40% of project costs, and that's for mature technologies, and 40 to 60% for first-of-a-kind projects. So on average, a 40% subsidy share seems reasonable. But even with those lower discounted EU ETS prices, ETS revenues will be significant to fund these incentives. We also introduced new framework for fracture scenario. Here we assume a price corridor is implemented, and carbon prices will held at 55 by 2030 and then gradually rise to 85 by 2050. That's in real terms. Regarding the Renaissance scenario, high decarbonization targets will require costly abatement options, and those will include hydrogen that needs to be deployed at scale for industry. So now let's move to the Western advanced economies. On the Renaissance scenario, we expect that Canada and the United States could reach carbon prices levels comparable to the EU. However, if we look at our most likely scenario, the base case, the picture is quite different. In Canada, prices under output-based pricing system, or PPS, would follow the legislated federal carbon price schedule until 2030. They will reach 170 Canadian per ton in nominal terms, and then stabilized there in real terms. In USA, we do not expect a nationwide ETS to be introduced, and carbon pricing will remain fragmented at the state level there. In Australia, prices under safeguard mechanism will increase from current levels, but are expected to trade below cost containment threshold. And that's largely because of the significant inventory of ACCUs, Australian carbon credit units, that is available in the market. Moving to the major Asian economies, we don't expect any of them would reach EU carbon price levels under any of our scenarios. In China, the national ETS is set to transition from intensity-based system to absolute cap over time. So this shift will push prices higher. But under our base case, they are projected to reach only about 40% of previously forecasted EU price levels. In South Korea, carbon prices have potential to rise higher than in China, roughly to half of EU price levels under the base case. And in Japan, a mandatory ETS will launch next year. And similar to South Korea, prices could reach around 50% of EU price levels. So let's discuss some developing economies. Under all of our scenarios, we do not expect any of these markets to reach even today's EU carbon price levels. For example, in Indonesia, which operates a hybrid caps and tax model, prices could reach only 15% of EU price levels. Thailand, so we expect a mandatory ETS there in 2028, and prices could reach around 20% of EU price levels under the base case. And in Mexico, it has similar price potential to Thailand, but is expected to launch its ETS next year. And with this, I would like to conclude today's session. Thank you everyone for listening.